Hello students, welcome to EPG Pathshala. I am Navina Thakur from Commerce Department. Today we are going to talk on the module concept of financial analysis under the paper Accounting and Financial Analysis. Learning objective. The primary objective of financial reporting is to provide information to present and potential investors and creditors, others in making rational investment, credit, and other decisions. Effective decision making requires evaluation of the past performance of companies and assessment of future prospects. This module will focus on developing a framework for analyzing financial statements to make business decisions. The framework is intended to enhance the ability of qualitative and quantitatively assess financial information. Goal of course include learning to read financial statements for relevant information, understanding the impact of business, accounting choice and estimates. Cases are incorporated in modules and assessments in order to illustrate concepts and allow students to put into practice the tools presented. Introduction. Finance is a language of business. Finance is an essential and exciting area of management that many executives want to discover or explore in more depth. Financial analysis is an aspect of overall business finance function that involves examining the past information. Meaning of financial analysis. It is a process of evaluating the relationship between component parts of a financial statement to obtain a better understanding of a firm's position and performance. Definition of financial analysis. It is an attempt to measure the enterprise's liquidity, profitability, solvency, and other indicators to assess its efficiency and performance. First definition. It is a process of evaluating the relationship between component parts of a financial statement to obtain a better understanding of a firm's position and performance. Second definition. Financial statement analysis is largely a study of relationship among the various financial factors in a business as disclosed by a single set of statements, and a study of the trend of these factors as shown in the series of statements. The objectives of financial statement analysis in a firm. Financial statement analysis is the collective name for the tools and techniques that are projected to provide relevant information to manager for decision making. The purpose of financial statement analysis is to assess a company's financial health and performance. Financial statement analysis consists of comparisons for the same company over a period of time and comparison of different companies either in the same industry or in the different industries. Financial statement analysis enables investors and creditors to first evaluate past performance and financial position, second predict future performance. Now, evaluation of past performance and financial position. The starting point in the analysis of a company is to look at the record. Past information serves as the base for the future. For example, trends of past sales, earnings, cash flow, profit margins, and return on investment provide a basis for evaluating the efficiency of company's performance and aid in assessing its prospectus. An assessment of current status will show where the company stands at present, such as the company's inventories, borrowings, and cash positions. To a large extent, the expectations of investors and creditors about future performance are shaped by their evaluation of past performance and current position. Individual investors are often passive and they rarely invest in the working of the company as long as the company is reasonably successful. Their evaluations of the company help them assess prospects for their investments, and investors who are dissatisfied with a company's performance will typically sell their shares in the company. Second, predict future performance. Financial performance analysis helps to predict the future on the basis of previous or last year data which are available. It is accepted fact in company organization that in order to decide for the future, a company needs the base year. Here, base year means previous year. The sale can be predicted for the future on the basis of past year sales. Similarly, profit can be estimated for the coming years by using various tools of analysis in which base year can be taken. Estimating budget is one of the significant functions of company organization, and financial statement analysis play enormous role in estimating budget for the future period. Standards of comparisons. Pertinent standards are used by the analyst to determine whether the results as per the financial statement analysis are favorable or unfavorable. For this purpose, comparisons are made with the general rule of indicators and with the past performance of the company and industry standards. First, general rule of indicators. Financial analysts and bankers use rule of thumb or benchmark financial ratios. Rule of thumb measures are useful in making broad comparisons of companies in different industries. Second, past performance. It is common for financial analysts to compare measure of performance of the company over a period of time. 7 or 9 year summaries of selected financial data appear in some annual reports. In industry standard, the performance of the company can be compared with that of other companies in the industry. The comparison helps overcome the limitation of historical comparisons. Now, the concept of financial statement analysis. The term financial statement analysis include both analysis and interpretation. Financial statement analysis gives structure relationship of various items in financial statements. Financial analysis of a company should include an examination of financial statements of the company. Financial analysis of a company should include an examination of the financial statement of the company, including notes of the financial statement and the auditor's report. The auditor's report will state whether financial statements have been audited in accordance with the journal accepted auditing standards. The report also indicates whether the statements fairly present the company's position, results of operation, and changes in financial position in accordance with the journal accepted accounting principles. Analysts often compare the financial statement of one company with other companies in same industry and with the industry in which company operates, as well as prior year's statements of the company being analyzed. Rationale of financial statement analysis. The purpose of financial statement analysis is to examine past and current financial data so that SWOT analysis can be done by the company. SWOT, in SWOT, S stands for strength, W stands for weakness, O for opportunity, T for threats. SWOT helps the company to analyze its strength, to compete in the market, and to avail the various opportunities available in the environment. Through this SWOT analysis, company makes various strategies to overcome the threats. Moreover, financial statement analysis can yield valuable information about trends and relationships. The quality of a company's earning. The another purpose of financial analysis is to diagnose the information contained in financial statements so as to judge the profitability and financial soundness of the firm, as it is linked to the objectives and interests of various agencies involved, like investors, bankers, lenders, suppliers, and regulatory authorities. For instance, just like a doctor examines his patient by recording his body temperature, blood temperature, etc., before making his conclusion regarding the illness and before giving his treatment. Similarly, the financial analyst analyzes the financial statements with various tools of analysis before commenting upon the financial health or weaknesses of an enterprise. The analysis and interpretation is essential to bring out the mystery behind the figures in the financial statements. However, on the basis of financial statements, The objective of financial analysis is to draw information to facilitate decision making, to evaluate the strength and the weakness of a business, to determine the earning capacity, to provide insights of liquidity, solvency, and profitability, and to decide the future prospects of a business entity. Different sources to collect company information. The various individual investors and creditors often interested in the company's report where they have invested their capital. The most common sources of information from where investors can collect all the relevant information are companies' reports, stock exchange, business periodicals, and information services. The brief discussion of all these sources are discussed as follows. Official record of company. It is mandatory as per the Companies Act 1956 for every company to publish an annual report which contains valuable financial and other information about the company. The typical Indian company includes directors' report, financial statements, schedule and notes to the financial statements and auditor's report. Second, stock exchanges. Listed companies must file copies of their annual reports as well as additional documents such as a statement of distribution of shares ownership and the quarterly statement with the stock exchange in which they are listed. The investors are interested to know the market value of their share. Third point, business periodicals. Business newspapers and magazines are important and often timely sources of financial and business news. All the newspapers give daily stock prices and carry news items and analytical write-ups on companies. It helps the investors to take decisions regarding further investing and withdrawing. Fourth point, information services. In recent years, a number of information services have sprung up. Interested parties can draw information from various sources like economic reports, Reserve Bank of India, and from private sources. Uses of financial analysis. On the basis of financial analysis, one can take variety of decision in various areas such as security analysis, credit analysis, debt analysis, dividend analysis, mergers, and journal business analysis. These are discussed as follows. First, security analysis. Second, credit analysis, debt analysis, journal business analysis, dividend decision analysis. Now, first, security analysis. It is a process by which the investors come to know whether the firm is fulfilling his expectations with regard to payment of dividend, capital appreciation, and security of money. Second point, credit analysis. Such analysis is useful when a firm offers credit to the new customers or a dealer. The manager of a firm would like to know whether they extend credit to them or not. Next point, debt analysis. Such analysis is done by firm to know the borrowing capacity of a prospective borrowers. Next, dividend decision. Dividend is that part of profit which is distributed among shareholders, and financial analysis helps the firm in deciding about the rate of dividend. Management would have to decide about how much portion of earnings to distribute and how much to return. Such decisions indicate the profitability of the firm. Next point, journal business analysis. Financial analysis can be used to identify the key profit drivers and business risk in order to assess the profit potential of the firm. It helps in future growth scenarios for the firm. Procedure to analyze the financial statement. First step, setting objectives by defining the purpose and context. Second step, collection of necessary information from different sources. Third step, process the data gathered in the second phase to preparing common size and financial statements and graphical representation. Fourth step, conduct analysis on processed data and interpret the results. Fifth step, develop recommendations in the light of inferences drawn from analysis conducted and communicate them to relevant persons. Step 6, follow up or review, if necessary, so that if any deviations occur, action may be taken to rectify the same. Step-by-step procedure to analyze the financial statements. Step 1. Setting objectives by defining the purpose and context. Second step. Collection of necessary information from different sources. Third step. Process the data gathered in the second phase to preparing common size financial statements and graphical representations. Fourth step, conduct analysis on processed data and interpret the results. Step 5th, develop recommendations in the light of inferences drawn from analysis conducted and communicate them to relevant persons. Step 6, follow up, if necessary, so that if any deviation occur, action may be taken to rectify the same. Role played by financial analyst in interpretation. Finance is one of the key departments of an organization as it involves organizing data according to logical and consistent accounting procedure. It covers a range of activities from basic bookkeeping to providing relevant, reliable, timely and accurate financial information in the form of various financial reports to assist management in the process of strategic decision making. The financial information in turn form a basis for financial analysis. Financial analysts are required to analyze different types of financial information and provide recommendations to their clients or end users. In that sense, analysts work as an advisor who advise or recommend appropriate action that users should take to gain favorable results. In this way, financial analysts play a vital role in a business organization and performs various roles and responsibilities. Some major duties of a financial analyst are as follows. First, financial analyst has a key role in determining the company's current value and future business prospects. Second, financial analyst involves analyzing financial information to produce forecasts of a business that aids greatly in making investment decisions. He needs to interpret data influencing investment decisions so that he may offer reliable and accurate information to management and recommend course of action. Third point, an analyst, in order to enable management in making various decisions accordingly, involves in creating various spreadsheets, making analysis and graphs so that the financial trends may be illustrated as well as clear and understandable information may be presented. Fourth point, an analyst holds the responsibility of developing several models in order to predict business opportunities in terms of investments, leading to maximizing profits and minimizing the chances that poses risk on businesses. Fifth point, one of the most important job activities of a financial analyst is, while reviewing and presenting the financial information to management, to analyze trends in terms of revenues and expenses of a business entity that consequently facilitate management to take necessary steps to increase profitability and decrease and control the expenses. Sixth point, while participating in forecasting and planning cycles and develop tools for improving the forecasting and actual processes, roll them out to the larger population together with identifying projects. Roles and responsibilities. Determining the company's current value and future business prospects. Analyze financial information to produce forecasts of a business that aids greatly in making investment decisions. Involves in creating various spreadsheets, making analysis and graphs so that financial trends may be illustrated. Holds the responsibility of developing several models in order to predict business opportunities in terms of investments, reviewing and presenting the financial information to management, develop tools for improving the forecasting and actual processes with identifying projects. Loopholes in financial analysis. Financial statement analysis has its numbers of limitations. Statements represent the past and do not necessarily predict the future. However, financial statement analysis can provide clues or suggest a need for further investigation. Financial statements say little directly about changes in markets, the business cycle, technological developments, law and regulations, management personnel, price level changes, and other critical analytical concerns. Some of the important limitations of financial analysis are, however, summed up as follows. First, financial statement analysis is only a study of interim reports. Second, it is based upon only monetary information and non-monetary information factors are totally ignored. It does not consider changes in price levels which have major impact on EPS, earning per share of the company. Fourth point, as the financial statements are prepared on the basis of a going concern, it does not give always an exact position. Thus, accounting concepts and conventions cause a serious limitation to financial analysis. Change in accounting procedure by a firm may often make financial analysis misleading. Next point, analysis is on a means and not an end in itself. The analyst has to make interpretation and draw his own conclusions. Different people may interpret the same analysis in different ways. This is one of the basic limitations of financial statement analysis. Analysis and their area of interest are as follows. First, investors of owners or shareholders. Area they are interested in: profitability, financial position, future prospects of business. Second, management. They are interested in short-term and long-term solvency, liability of the concern, profitability in relation to turnover. Next, employees and trade union. They are interested in profitability, financial position of the concern. Suppliers are interested in financial position, profitabilities. Researchers, they are interested in profitability, growth, future prospectus. Future performance. Financial analysis can assist small businesses in their planning and evaluation of a company's balance sheet, income statement, and cash flow statement. It helps in interpreting trends and identifying strengths and weaknesses of a business to enable management to make projections of revenue and profits for future. With knowledge of trends in the general economy and in the company's industry, they can form a reasonable estimate of how well the company might fare in the coming years. Such analysis can be helpful to businesses that need to plan equipment purchases and other initiatives. The process of division, establishing relationship and interpretation thereof to understand the working and financial position of a business is known as analysis of financial statements. It indicates certain absolute information about assets, liabilities, and profit or loss of an enterprise. There are various parties in financial statements. So, students, let's see what we have learned from this module. First, financial statements are prepared primarily for decision making. Next, the purpose of financial analysis is to diagnose the information contained in financial statements. The financial statements are mirror which reflect the financial position and operating strength or weakness of the concern. Investors and creditors use financial statement analysis to evaluate the past performance and current position of company. Investors usually depend upon published sources of information about a company. The analysis of financial statement is useful for assessing the efficiency for different cost centers. Financial analysts make comparison with rule of thumb, indicators, past performance of company and industry standards. The estimation of future earning from current earning is an important part of financial analysis. Financial analysts are required to analyze different types of financial information and provide recommendation to their clients or end users. The auditor's report will state whether the financial statements have been audited in accordance with generally accepted auditing standards.